Hello, everybody. Welcome today. I'm so excited to be able to talk about how to unbank yourself. Definitely chime in. Those of you I know you're just starting to pop in here because you're streaming live, whether it be through Facebook, LinkedIn, YouTube. Go ahead and chime in, comment, just say who you are, where you're from. Well, I guess we kind of see who you are because we see the comments, but tell us where you're from around the country or maybe even around the world, depending on where you're coming in from. This is more of a US focused strategy, but hey, we always willing to welcome you. So definitely chime in, let us know who you are and where you're at. All right, so as you guys are doing that, definitely I'm going to talk about today is really to help you guys understand how you can do this, right? How can we have something that's tax free, guaranteed, better returns than the bank, and even better protection? Because the truth is that we see a lot of crap out there today, and we kind of wonder what happens. All right. So as you guys are making comments, feel free to ask questions along the way. I won't be able to see it when you ask these questions. So go ahead and ask the questions. I will answer them at the end of this. So we'll be sure to leave some time for you there. Okay. Let me go ahead and rock and roll here. Okay, so as I said, we're going to talk about how to unbank yourself. A little bit about me. I live in the state of Utah most of the year, although I do snowbird in the winter because my wife's from the tropics. She hates Utah winters. And now, because she spoiled me, I now hate Utah winters. But beautiful place to live in if you guys ever been out here. Wonderful place to raise a family. But definitely it can get cold. So we make sure we can make the great escape during the coldest time of the winter. My wife and I, we actually got married almost 7 years ago. We have a blended family of 8 children. 6 of them are teenagers. This is why my beard and my hair has gone gray, right? Because you definitely feel it as it comes along. But definitely been very grateful to have them. I have 6, she has 2, and that as a result, when the kids come over, she says, "Your job." So, financially independent twice. I talked about this in other webinars, but I actually was able to become work optional, meaning that had enough passive income coming in that allowed me to be able to really get out of the rat race. And kind of give you a backstory here is really I was raised by good, hardworking parents. My mom was more the dreamer and the artist. She's the one that taught me to follow your passions and leave something beautiful on the planet. My dad was the one that taught me to your word is your bond, to be in integrity and be honest and work hard. And so those two parents coming together kind of created me, and I mean, taught me good stuff. But when it came to money, it wasn't so much the case, right? Because I would hear words. Maybe you've heard this too, growing up. But things like, "You can't afford this." We can't afford this as a family. Come on, it's too expensive. We think money grows on trees. I'm not made of money. All those kind of things. And even my dad would talk about how he said, "Chris, I'm going to work until I'm dead because this job is going to literally kill me." And by the 40s, his 40s and 50s, he'd already had strokes and heart attacks by that point. I didn't want to live that kind of life. And so I chose a different path. I chose a path actually that led me becoming a financial advisor because I want to have my own business and control my time and destiny. But I realized this as a financial advisor a few years in, I sit down with my dad. He says, "Chris, look at my finances. I want to retire. I'm 61 years old. I want to be done." I look at his money. And remember, this guy is the guy who was like the penny pinching saver, maxed out his 401ks. He had paid off all of his debt in 18 years. By the way, this is the first time I ever saw his finances open up because he never opened up about his finances to his kids. He never wanted us to ever think he had money. Now, he starts opening up all of his books and everything. I see what he's got. He's like, "Okay, Chris, can I retire?" I said, "Dad, I'll be honest. If you want to retire today, you better hope you die in 5 years because that's when you'll run out of money." And he said, "Well, what do I do?" And I didn't have the answer because he had done everything right based on me being a financial advisor. And the next thing you know, it kind of led me down this path of trying to find answers. Like, well, how can he retire? How's a guy that did everything right still not able to retire? Did everything that financial advisors told him, did everything that Dave Ramsey told him. Actually, he probably told Dave Ramsey what to do because he's older. But, I mean, he did everything right, but it wasn't enough. And then I started to realize that I was on the same path as him. Even though I wanted to live a different life and have more freedom, I was still doing the same thing, being cheap, trying to be miserly, save up all my money and stuff it in mutual funds, just like he did. And it didn't work. And I found out that pretty soon, when the students ready to teach their peers, I met a friend. And this friend, of course, he said, "Chris, there's a whole better world than that. It's in real estate investing and doing alternative investments that create passive income and cash flow, not just storing your nuts away in some crappy mutual fund that the market could take away at any moment," which is what happened to my dad with Y2K and the Great Recession and everything. And so I started going down that path. And that's actually how I became financially independent the first time. Now, while doing this, This is where I learned not only about how to create passive income, but they start talking about this other focus we're going to talk about today, how to unbank yourself. All these real estate guys are super excited about it, and we're doing the strategy. And I'll just tell you that strategy actually stinks compared to what I'm going to teach you today. So this is something that's not new. It's something that's been around for a while, but I found better ways to do it. So let's dig into that right here. So what if I could actually show you guys something somewhere you can store your money that's safer than a bank or gambling in the stock market even. It's tax-free, guaranteed returns, protected from sue happy criminals, especially if you're in the state, especially if you're in the United States, right? Everybody loves to sue people, but it's protected from criminals. Oh, by the way, bonus, you can actually count it as a way to finance education. You can actually use it to help buy a house. And even better, it can become a passive income booster that will shave off years from you towards your getting your financial freedom goals. Just like hundreds of my clients and I have done myself, that we've done over the last several decades. And obviously, if I can show you how to do that, would you like to see how it's done? Hopefully so. If so, that's why you're here, right? So that's the big thing we're going to talk about. But again, there's challenges. There's a lot of headwinds happening right now, right? We've got the government, of course, racking up debt and everything. And of course, even if you try to put your money into 401ks and IRAs, who's to say they're not going to raid those to be able to pay their crappy tax bills, right? So we got that issue about where do we even store money that we could be protected from the government trying to dig their hands in? What about Silicon Valley Bank, and Signature Bank, and even Credit Suisse, and even recently, there's a regional bank in California that got bought up by the California Bank or Bank of, right? They actually bought them out. They were a big bank, and they got bought out by a smaller local bank in California. There's still these kind of bank failures happening today, but everybody keeps saying, "Oh, it's just a fluke." Is it really? Can there really be big banks that fail and then the rest of them are all fine? Seems fishy to me. And not to mention you got stupid inflation, right? Even if you try to put your money in the bank and you get paid point nothing percent, inflation is going to kick the crap out of you. It's become worthless. You might as well bury it in your backyard. Not a recommendation, by the way, right? And of course, we got interest rates. Just yesterday we had the Feds raise them again, and they're still predicted to raise them more. And I love this. You gotta love this picture of Johnny Depp's ex-wife, right? I mean, you sure hope interest rates still go crazy, and then what do you see? They're going crazy, right? And so they're going sky high. And even worse, it's just you don't know where to turn. You don't know where to put your money in the stock market because that's way overbought right now. It's way overvalued that it could come crashing down at any time. You've even got real estate. You're kind of wondering, should I even put it in there? Is that even safe? Especially if you do it like the traditional way that average people do. Real estate's going to kick your butt most likely in the next few years. So you got to be careful. So where do you store it that you can actually have some certainty and not worry about all this drama and this crap that's going on in the world today? That's what we're going to talk about today is get yourself away from banks, get it away from that risk. Because I do think there will be more bank failures. This is the answer to help you do that. And like I said, this is not the first time I've done it either. This is not the first time. I'm not the first person to teach this. It's been around for years and years and years. By the way, I'm going to actually share with you how you can even use this strategy to become work optional faster. Meaning that if you have a goal is to create enough passive income to be work optional, to work because you want to, not because you have to, this strategy will actually allow you to do it even faster. Okay. So, but I'm just telling you though, the average people out there, including the average financial pundits like your Dave Ramsey's and your Susie Ormans, they just don't get it. Even if they've heard of it, they don't really understand it, or they try to skew it and lie essentially about it in the media. And so you look this stuff up. I mean, you're going to find all kinds of information out there. I'm going to show you the way that it's done best. And I will tell you, there's even times I do agree with them in certain degrees, but they just don't understand how it works. They just try to keep you really limited, and it just doesn't really produce the results. But I'll tell you, I mean, this has been something that even though those financial pundits, those average pundits out there talking to broke people, although they say don't do it, banks have been doing this for decades. They've been doing it for a long, long time. And even guys like Warren Buffett, he's starting to hold more and more money in cash lately. In fact, that number is now, like I said, over $130 billion. He keeps adding more cash and putting it into safer places like what we're talking about today. So what I'm going to talk about today is about called max ROI infinite banking, right? This is a strategy you're using your high cash whole life insurance. Now, here's a warning. This is not your average grandpa's infinite banking. This is not like just Nelson Nash, who just passed away 4 years ago. This is not using the same strategy that you hear people talk about that are just insurance salesmen, right? There's a ton of just crap out there right now of using this strategy, but they make this long-term, put it away forever, expensive strategy. This is where Dave Ramsey and Susie Orman say don't do it. And I agree. Because if you use the traditional strategy of this infinite banking, you will lose money, potentially hundreds of thousands, if not millions of dollars unnecessarily. It's needless. It's just pointless to do it that way. So I'm going to really talk about what we talk about, which is like this no BS infinite banking, right? Really not BSing you around, not helping to make it convoluted and complex, not making it to where it's just super expensive. And I'll tell you, like when I first learned about this, like I said, I was starting to get out of the rat race and become financially independent when I was 28 years old. By the way, I did it twice because the recession kicked my butt, and I had to become financially independent again. I had to get back out of the rat race a second time, and I did that by 2016. But it's interesting because I started to learn all this stuff, and of course, all these real estate investors like you should check out Infinite Banking. Read this book by Nelson Nash, Becoming Your Own Banker, which by the way is a good book. It's a good basic book to start with. But they're like, read that book and it's going to blow your mind. So I did. And I'm telling you, like, I was a financial advisor for 4 years prior to this, never even heard of this strategy before, didn't even know it existed. In fact, whenever somebody talked to me about whole life insurance, I was like, that's the crappiest insurance you could ever get. You might as well just buy term and invest the difference. You ever heard people say that? By the way, actually, just a recent study came out. I just did a podcast on it a few weeks ago with the same kind of title as this webinar called Unbank Yourself. There's a study that came out that actually showed comparing buy term invested difference to whole life using annuities and everything else. Buy term invested difference was the worst strategy to use. It came out with the Monte Carlo simulations, meaning the different variations of the stock market, everything else, end up having the worst results. The worst. If you want not just cash later, but also even passing on money to your heirs too. So very, very interesting thing to see that even if you weren't trying to pass on money to your heirs, that was a strategy that didn't work. So that's what I was telling people. Like, don't you dare do something like whole life insurance. You make no money. Now, the only reason I said that is because other financial advisors taught me to say that. I didn't know for myself. I didn't know how it worked. So I started learning that you could actually use this money as a way to essentially become your own bank, as they say, right? Where they would teach you how you could buy cars, and not have to pay bank interest. You can pay interest to insurance company instead of potentially a lower rate and save money that way. You could buy a house that way. You could do all kinds of things to essentially keep that control under your own control, essentially. And I thought, well, that's pretty cool. And because all the other guys, the real estate guys are doing, I'm like, all right, I'll give it a shot. And I remember asking, I was like, well, can I make this better? Because I noticed that this is really expensive up front. Like I don't have any money in these first 2 years. I'm putting money in. Could I do it where I actually am more flexible with premiums? Because I knew with certain other types of life insurance policies, I could do that. And they said, no, you can't. So I trusted the guy and I did it. That was 2006. Now, of course, 2008 was not a fun year, especially if you were a real estate investor. And especially if you were like me, starting a new business with a guy named Garrett Gunderson. We started a business focusing towards real estate investors that were just flippers. So when those people went broke, our company started going broke. It was like the perfect storm. Not only my real estate wasn't paying me well, nothing was going right. And I was in the hole, cash flow wise, I was in the hole like 15,000, 16,000 a month. I couldn't afford to even pay the extra $1,000 a month premiums I was paying towards these whole life policies. Well, guess what? As a result, because there's no cash in there, no savings, tax-free savings account in there, I lost it. I lost the 25,000 I paid in. It was gone. I was, I was depressed. Of course, I thought, well, that's just the way it is. You know what made me mad? Just several months later, I'm talking with a friend of mine who also bought the same kind of policy, found out we could have done it better. And I found out you could actually do it in a way where you lower the cost, have cash from day one. So this actually becomes not just an insurance type of thing. This becomes an actual tax-free supercharged savings account where this can actually build cash quickly with minimal cost. And in fact, it'll even pay for itself in about 4 years. And I thought, now that's better. And I remember confronting that insurance agent. I said, look what I found out. You could have actually done it this way. Now, he argued with me all these different reasons why you couldn't do it that way. But you know what it came down to after a 2-hour debate and me showing him actual insurance numbers because I ran them for myself? You know what I found out? He said this to me. He said, Chris, the reason I didn't do it that way is because I can't afford to cut my commissions. That right there, guys, is where you get BS'd around. Is that you get guys that are not investors. They're insurance agents. That is the career, to make commissions, and they're in scarcity. And as a result, what do? They sell you something that's super expensive. That is why there's negative media about it. That is why you could actually lose hundreds of thousands, if not millions of dollars doing it wrong. This is what I'm going to show you is how you do it right. Now, before we get into that, I want to talk about who is this not for? Okay. I really want to help you understand that this is not for everybody. This is not the magic bullet. And by the way, this is not even the thing that's going to get you financially free by itself. It doesn't work by itself. You need other strategies. It's like trying to do a diet only cutting out carbs, right? You can't just cut out carbs and think that you're going to be the fittest, most, fit, beautiful person ever just by only cutting out carbs. There's more to health than that. Same thing with money. This is a great strategy. It can help you along, but it does not work by itself. So who's this not for? One, if you're in bad health, this is probably not for you, right? I had a guy who was about 400 pounds, and he said, Chris, I'm pretty sure even if I get qualified, it's going to be really expensive. And he was right. But you know what we did? Of course, he was in his 50s too. He said, but my wife, she's a few years younger than me, and she's also in perfect health. I said, we can do a policy on her instead. So even though we didn't do a policy for him, we did on his wife, putting in over 100,000 a year that's growing tax free that he can then use to invest in his real estate projects. So that's an example right there. So again, if you're in bad health, smoker, this may not be the greatest thing for you. We might do a different strategy for you if you need life insurance. But again, the focus that we're doing here is not so much the life insurance death benefit, but the living benefit, the cash that you can actually grow tax free. Now, it may not be for you if you're paycheck to paycheck. If you're barely making ends meet right now, this is not a strategy for you. You would be better off buying a cheap term policy that you can then convert later on to this kind of strategy. But instead, if you're just paycheck to paycheck, if you can't save at least, I would say at least a few thousand, $5,000 a year, this is not the strategy for you. Also, if you're over the age of 70, we're probably not going to do this kind of strategy. Now, if you are over the age of 70, you can get insurance still, but we're not going to do it just like this. It will be something more unique to you. So if you're over the age of 70, bad health or a smoker, or you're paycheck to paycheck, this does not work for you. That's the key thing here. But if you are somebody who is saving at least 5,000 plus a year, maybe you're saving to your 401ks, maybe you're just putting into savings, wondering where to put it, and you're not sure where to do that, what to do with this. Maybe you have an emergency fund right now that's all in the bank. You know it's at risk because what if your bank is one of those that actually ends up failing here in the near future? If we run into a recession, which we are overdue for a recession, there could be more and more bank failures than what we've heard about today. So again, can we store this money more safely using it in here rather than there? And of course, make more than 0.0%, and it's tax free. Right? That's the key thing. Like I mentioned, it is tax free. It's like a Roth IRA, but you don't have all the dumb 59.5 rules, which you see. No stupid limits or penalties. You don't get penalized 10% for touching your money before you're 60 years old. You don't have the limits where if you make too much income, you can't even use it. That's not the case here. In fact, you can put in 25% of your stated gross annual income into this every year. So you can actually put a lot of money into this. It's protected from lawsuits and creditors. In most states, it's 100% protected from lawsuits and creditors, meaning that if you have, say, $1 million saved up in this, maybe millions even saved up in this, guess what? Even if somebody sues you and wins, and that includes creditors that you're indebted to, they cannot get to this money. The only people who can get to it is the IRS because they can get to anything, even your offshore accounts they can get to. Bet you didn't know that. So this is something you can actually have protected from lawsuits and creditors 100% in most states. Other states, it's just more limited protection, but still there's protection around these that allows you to grow it. Like I mentioned about college savings plans. One of the cool things is it does not count against you as an asset when you're trying to get financial aid. So even if you have millions of dollars in here, they won't count as an asset when you try to get your kids financial aid, which means you could get them grants or scholarships or something else because they don't even look at this money. It's awesome. Another thing too, guaranteed growth. I mean, even right now, they're paying at least 5 or 6% a year tax-free that they're paying on the cash that are inside these policies. That means even after expenses and costs that come out of it, you usually net at least 4 or 5% rate of return tax-free, which compared to people putting money in the stock market, that's like you getting at least a 6 or 7% type of return. Some people more. Like I said, no stupid limits, penalties. You can have bank leverage. You can actually use this. I'll talk about that in a little bit. And most importantly, you have access to cash now. Unlike the one that I set up where there was no cash available, it went all to paying insurance costs in the beginning. You could actually have cash from day one in this, allowing this thing to actually be more protected and give you more liquidity, more money that you can be using for yourself. That gives you more peace of mind. Now, Going along with that, emergency funds and reserves is one of the ways you can do this. Here's a strategy I could recommend today. Here's a way, because many people say, well, how do I fund this? How do I make it work? Right. Well, one thing you do is actually do it as an emergency fund. You can start taking some of the money from your emergency fund that you have sitting in your bank savings account and start moving it over. I wouldn't recommend necessarily trying to move all of it over at once. Right. I'm not talking about just trying to dump a whole bunch of cash in there because that can make it more expensive than it needs to be. So we try to keep the cost minimal while moving that money over. But you might be funding this over the next few years just using the bank savings that you have that you're not supposed to be investing anyways. It's your emergency fund, moving it over, essentially just transferring over from one account to another. Yes, there are net costs in the life insurance. That's true. That's why we also don't just throw it all over day one, right? We do this in phases. And the great thing is, if you guys ever want to know how to do this, like I said, like we're offering this, we actually do this in-house within our company. We actually have people that can actually help run numbers for you so you can see what this looks like in your specific situation. But you can actually use this as an emergency fund. So in my situation, give you an example. My wife wants $300,000 that does not get touched, does not get invested. It's there just in case the world blows up, right? Well, I know that keeping $300,000 in my 0.1% credit union savings account is not going to be too great, because that means that 300,000 makes 300 bucks a year, and then I get taxed on that 300 bucks, meaning I only make 200 bucks a year. But what I did do is I told her, listen, hun, instead of just keeping it in the bank, why don't we earmark some of the money that's already in this life insurance? Instead of investing it, let's earmark more of this to be liquid cash. And so I keep 250,000 inside of here that earns, like I said, roughly about a 5% return. That's 12,500 a year, tax free. The other 50,000 still sitting in the bank, making my 50 bucks minus taxes, right? So I'm still making, guys, I'm making over 12,000 more a year just by having my money here instead of keeping it in the stupid bank, right? Which again, there's more, risk of loss. By the way, speaking of risk, many people will ask, well, aren't insurance companies at risk just like banks are? And that's a great question. The cool thing is with banks or with insurance companies, let's give you an example. The Great Depression. Did you know that almost 2/3 of banks failed in the Great Depression? There were about 35,000 banks, but after the Great Depression, there was only about 13,000 left. That means out of 35,000 banks, 22,000 failed while 13,000 remained. Insurance companies, life insurance companies, 4 went out of business during that period of time. And even if they do, now insurance companies are required to buy what's called reinsurance, which means insurance companies then insure the insurance companies. So if the insurance companies ever fail, then insurance company steps in, make sure that your cash is protected as well as your death benefit too. So when people say, well, could this be safer than the bank? Well, compared to the FDIC, which is supposed to protect your money in the banks, but they have less than 2% of reserves in there. Think about it. If 10% of banks fail, they're going to be scrambling trying to figure out how to get you your money back because there isn't enough in FDIC to pay for that. So just know, if we ever have another depression, not a good place to have your money if it's in the bank. So again, you can keep your emergency reserves in here. Know that you're not only making a better return, it's tax-free, but it's also safer. Use it for cash flowing investments. That's another way to do it. I love using this strategy because if I use this to buy a real estate property, I'll show you an example of that later. I can actually get this, guys, double dip on my money. I can actually get my money to pay me in 2 places at the same time. You can also use this collateral. I had a client who was trying to buy an office building. He went to go use this strategy, for example, he was actually going to cash out the money. He was thinking of just cashing out all of his life insurance to use to buy the building in cash. I told him, don't do that. Instead, go to his credit union and ask him, said, listen, can you put a lien against my life insurance? Use that as collateral because it's guaranteed, and then give him a loan. The bank did. And they not only gave him a loan, but they gave him a loan 2% lower than the going rate, which was kind of similar to the rates they are today. So he actually got a loan for like 3.25%. His payment was $1,800 a month. He built out that office. He even started renting people, so it was paying for his payment for him anyways. And then he went back to the bank. He says, hey, listen, we built out this office. There should be enough equity in here. Can we just use the office now as collateral? And what did they say? Yes. They said, yes, you can. And they took that lien off his life insurance, but kept his terms the same. He still has the same great interest rate as if he used the life insurance, but now the life insurance is free to use however he wants. You could also pay off loans. If you have high interest credit cards, which have been skyrocketing lately, maybe in home equity lines of credit. I've been talking to clients about that lately where their home equity lines of credit are going crazy. Use this to pay it off and save yourself the interest. You can also have extra retirement income, tax-free retirement income that can actually come in. Cool thing is usually you can pull off about 7 or 8% of the total balance in there for life, based on how the calculations work and how the returns work. And as I mentioned, you can use this for kids' savings. Lately, I've had so many people say, I hate my kids' 529 college savings plan. Can I do something else? The answer is yes. You can do it in here and you can invest it however you want versus have it gambled in the stock market and lose potentially right before the kids go to college. So let's talk about this double arbitrage concept. Hopefully, you guys are with me. Again, questions are coming up. Type them in so in case you don't forget them. We'll answer them later on. They might be answered here, but let me get into a little bit more about this double dip effect that's going on here, right? Because this is what I mean by arbitrage. Arbitrage is like when you walk into a bank and you look up on the signs up there or the screens and they have advertisements running, right? They have like their interest rates for their savings accounts and their CDs. And then they have their auto loans and mortgages that they're advertising. And if you look up there, you'll see they'll say, hey, 5-year CD at 2% interest. And then you'll look at the other wall and it'll say 5-year car loan at 6.5% interest, right? Or maybe 7% interest now. Well, you see 2% for a 5-year CD, say 7% for the car loan, 5-year car loan. You're like, wait a minute. If I give him money to put in that CD, say I give him $10,000, who's to say they couldn't just turn around and take that 10,000 because it's kind of locked up in that CD and use that to loan out to somebody else at 7%, right? So essentially they make not 5% on your money, they make a couple 100% on your money because they pay you $200 a year for that interest, but they just made $700 off that $200. That's what arbitrage is, right? It's taking money from like borrowing money and then using it to be able to work in your benefit. The cool thing is you can do that with this life insurance product as well. So here's how it works. Most people just take money, they invest it, they take the cash flow and put it back into savings, right? So if you buy a rental property, say it makes $500 a month, you take that $500 a month and you put it in your bank account and you build it up till you have enough to invest it again, right? And that's kind of how it cycles through. Same strategy, but instead of using your bank, which again doesn't pay you much anyways, you use this instead. So you take that $500 of that cash flowing property, you put it in here to build that cash, and then you use that to do it. But here's what you're going to do. Because you already have cash in this policy, right? Say you've started to build up that cash. Maybe it's from the money you've moved over from your savings account for your reserves. And now you want to borrow against it. So you borrow the money from the life insurance company. Now, this is a myth. Many people tell you pay yourself back interest. That is false. That is a lie that those people are telling you because they sell you crappy policies and have to tell you anything to get you to buy it. Here's what it actually is. You are getting a loan from the life insurance company. You are paying them interest. But you are also earning interest on all the money in there. So you could just withdraw your money and just use it like you would for the savings account. But remember, when you pull money out of savings and you invest it, that money's not growing in savings anymore, is it? It's gone. So you're not earning interest in the savings account. You're just earning money on the investment. But what if you could earn money in the savings account and the investment at the same time as if you never touched it? That's why you would borrow from a life insurance policy. Because what you're doing is you're getting a line of credit from the insurance company. They'll charge you interest, yes. And let's just say that you have $100,000 sitting in there. You borrow $50,000 from the insurance company. Guess what? Your $100,000 is still there earning tax-free compounding dividends, right? Compounding interest. You're still earning interest on that, on the full $100,000, while you have $50,000 from them that you go and invest. And say, like I said, that $50,000 then produces $500 a month. You take that $500 a month and you use that to pay back towards the line of credit that you got. Here's the cool thing: when you borrow from an insurance company, there is no minimum monthly payment. There's nothing like the bank has. It doesn't show up in your credit report. It's a private loan, and guess what, guys? You can pay it back however, whenever you want. The deadline is your death. So once you're in the grave, that's when they do get paid back. That's the balloon payment, so to speak, right? They do want their money back at some point, but they're just going to charge you interest for however long you want to have it out there. And it's a really reasonable amount of interest. Right now, it's roughly about 5 to 6%, give or take. So they're charging interest while they're also paying you tax-free compounding interest on the rest of that money. That's a key thing. By the way, they only charge you simple interest. So you actually make more money on the compounding side than what you pay them on the other side. So you borrow that money, you invest it, take the cash flow, use that to pay down the loan. And what happens? You make more money. Let me show you how. So let's just say, for example, and I've used this example for a lot of my real estate friends. You may not do a project this big. And it doesn't matter the dollar amount. Just understand the concept here, right? Because you would think if you're spending 250,000 and you cash flow from that apartment, that's your down payment on the apartment, you cash flow 2,500 a month, you're putting back, let's say we were putting that back into a savings account, right? You're just putting it back like normal. This is what most, even most average investors do, is that they pull the 250,000 out of their bank, they put a down payment on their property, and then they're netting after they pay all their expenses, say 2,500 bucks a month. Well, that 2,500 is going back to slowly build up that savings account again while you're earning point nothing percent. So if you did that for 9 years, which means basically you got 270,000 because it's 30,000 a year times nine, you got that, did it for 9 years. Guess how much interest you'd make on a savings account after you've paid your taxes? 1,228 bucks. So after you just packed away over $250,000, you made 1,200 bucks in interest after tax. So over 9 years. Wow, talk about compounding interest. Whoop-de-doo, right? That's using savings account. Well, what if you did that same strategy using the life insurance? And by the way, I use my own life insurance numbers, my own policy. I'm in my mid 40s. Some of you that are in your 30s could get better returns than I get. If you're older, may not get as good returns, but the concept's still pretty much the same. Watch this. If you did that same strategy, instead of using the bank, use your life insurance, here's how much you made in interest. About 100 times better. 126,000. That's even after you've paid the interest cost to the insurance company. That's what you netted on top from putting that 2,500 bucks a month for 9 years. Guys, that's a whole nother down payment for another property to cash flow you maybe $1,000+ more a month than you would if you just use your savings account. That's a big, big deal. Again, you want 1,200, 126,000. Kind of kind of no brainer in my mind, right? Once I got this is when it all made sense. It didn't really make sense to me early on when I did this, but when I realized that you could actually reduce your costs and let this grow faster, allowing, basically creating less drag on this thing, right? You actually get a better return. That's how you make money twice, because you're making money inside the insurance policy and you're still making money on the investment. You still have that asset that's appreciating or doing whatever it's doing. And by the way, people always ask me, well, what can I use this for? Like, how can I use this? You can use it for whatever you want. You can blow it in Vegas if you wanted to. I just don't recommend that because not a very good rate of return usually if you blow it in Vegas, right? But you can use this for whatever you want. And like I said, you can pay it back however, whenever you want. That's the cool thing when you get to borrow from the cash that people say, well, it's all my own money. Nope, you're not borrowing from your own money. You're borrowing their money so that you can make more than what they're charging you. That's how you make money. That's the same way the bank makes money on you. You're just now turning the tables around where you become the bank. Instead, you have that power and control in your own life. And just so you know, I'm not the first person to do this. Like I said, this has been done for decades. Walt Disney did this for Disney World. You guys ever been to that happiest place on earth? That swampland, the only way the banks would give him money is if he put up collateral for it. His collateral was the cash inside of his whole life insurance policies. He said, if I put this up as collateral, will you guys give me the loan? They said, yes. The rest is history. We now have a massive park that's arguing with DeSantis right now, right? That's what we've got. Also, have you ever been to McDonald's? Ray Kroc, when he bought it for the McDonald's brothers, actually used his life insurance policy to keep paying those executives, the other executives, so that McDonald's stayed strong and made that transition when he became the owner. If you ever seen the lady on the right, this is the woman that created Pampered Chef. Her seed money for starting Pampered Chef came from her life insurance policy, not from the bank, from her life insurance. Buffett, like I said, he actually doesn't even stop here. He buys insurance companies. he likes insurance companies so much, he buys them. And by the way, he's also, like I mentioned before, he's got over $130 billion just sitting in cash assets right now, storing it, waiting for this impending recession that everybody said, oh, it's over. It's not happening again. Guys, I'm telling you, it's coming and it's going to be worse than what people thought it was going to be. Cool thing too is like this is another way you can unbank yourself. Remember, I told you there's a bonus here about how you can actually retire faster with this, become work optional faster with this. One of my clients sent me this. He said, Chris, here's my game plan. Now he didn't have a lot of money he's putting in, right? He's putting in like maybe 15,000 a year into his life insurance plan, but he's been using this money to also help invest. The cool thing is he's using the cash flow to keep cycling the money through. He's saving additional money on top of the life insurance too. And now with the different investments he's got his rentals that he's currently got, and he shows you the kind of, you see their year by year plan there. He's getting it to where the total net cash flow is 4,441. His goal, however, is to hit 5,000 a month. And you'll see at the very top, his investments get him to 4,250 by 2030. But the life insurance, because you can take off tax-free income even before you're at that old, 59 and a half retirement age that they tell you to do with 401ks and IRAs, you don't have to do that with life insurance. You can take it out and access it today to invest or even just to pull off tax-free income. So he's actually using this not just to help him save to buy real estate assets, he's also using this as tax-free income. So he was able to find a way to use that as supplemental income to come in to get to his $5,000 a month goal faster. If he had just done it only using real estate investments, it probably would have taken him an extra 2 years to do it. But because he's using his life insurance, he saved himself 2 years. And by the way, he's young. He's in his 30s right now. So he's actually trying to do this by the time he's in his mid 30s. Also, this couple right here, I mentioned how if you do the wrong kind of plan, it could cost you hundreds of thousands, if not millions of dollars. This couple we worked with actually on our other side of consulting, where we helped them with passive income and things like that. But they said, Chris, can you look at these infinite banking plans that we set up? And they were with a pretty well-known, popular infinite banker. And I won't mention his name because he is out there. And they said, can you just review this and make sure it's done well? And I said, some of these are like 5, 6, 8 years old. I don't think we should touch them because you've already paid your dues. Even if I wouldn't have set it up this way, even if it was more expensive up front, maybe it's worthwhile just to keep them. Well, I ran an apples to apples comparison because you can actually transfer your money over tax-free from one insurance plan to the next. And we ran it apples to apples and found out, guys, that they could actually increase their returns. Again, apples to apples, paying the same amount they're paying, increase their returns by $2.25 million in the next 20 years. So what does that mean? That means they're overpaying $2.25 million to that other plan. Needless to say, they wanted the $2.25 million. So we moved the money over tax-free, got it all taken care of and done. And their policy is much more efficient, making a lot more money. In fact, they don't have to pay a dime into it if they don't want to. It's already paying for itself. That's the cool thing with these kind of insurance plans, that you don't have to pay into them forever if you don't want to. So, anyways, that's kind of how these guys did it. So that's the key thing, guys. That's how you really unbank yourself. Like I said, the key thing is that you don't need this strategy to become financially free, right? You don't need this strategy to become work optional, where you can work by choice, not by force, because you need to survive. But you want to do it faster. You want to be able to protect your money, especially with the banks, what's going on out there today. I really don't trust banks at all. I'm still using banks, but I'm not keeping my lion's share of my money in the banks. I'm keeping it over here myself personally for this very reason. And by the way, we set up our policies just like I set up my own, right? We don't BS you around. We make sure you get the best rate of return guaranteed of anybody out there doing infinite banking. In fact, if you've even been looking at a strategy with somebody else, send us the numbers and we'll do an apples to apples comparison. We'll show you that. By the way, best way to reach out to us, you can always go to moneyripples.com. You can actually book a call. You can actually schedule us right there. We'll even put that in the comments here on the side for those of you that are here live. Those of you watching the recording, you can also just go to moneyripples.com. There's more information there. We even have a YouTube channel. We have a playlist on our Money Ripples YouTube channel all about this. But I'm telling you, I've pretty much given you the gist right now. You know enough to be dangerous. The next step for you is, will this work in my situation? And we'll be honest. If it's something that's not good for you in the situation, we'll say, no, this is not for you. Maybe do this strategy instead. But if you're already trying to do other things, like if you're already trying to invest creatively, like maybe you're trying to do things like real estate investing or investing in oil and gas or something different. Maybe you're trying to invest in your business. By the way, this is a great thing you can use for financing your own business. This liquid cash that's there, not only do banks love seeing that you have liquid cash sitting around, but to use this, especially if you're trying to use marketing strategies or ways to scale and grow your company, another great source you can use, just like Walt Disney did, just like, Lady with Pampered Chef, just like with her, McDonald's. There's so many ways you can use this. Really, the imagination is the limit. If there's anything negative that we get from our clients is, holy cow, there are so many things we could do with this now. What do we do? And the great thing is, there's ways we can support you there too. But that's the great thing, guys, is that this is something that, like I said, like it just drives me nuts that there's infinite bankers out there that are charging you way too much and that really don't teach you how to make it work for you now, not 20 years from now. Like they try to tell you like, oh, just wait till retirement. This is something that can actually benefit your life today. This could be something to benefit your children. I have clients actually are pulling their kids' money together to go do investments, and they're using that to pay for college versus just saving it and gambling it in the stock market where it may not work. They're even using it to, by the way, you can even turn over ownership later on if you choose to your kids. You can control all the money in your kids' names, use their benefit. I actually have a client right now who's putting on all three of his kids while also getting another policy on his wife. He's a fighter pilot, so he's like, I can't really get a policy very easily, but my wife's great shape and my kids are in good health. Why don't we put money in with them? So he's starting to spread that money there. And he knows that down the road, if he ever chose, especially as your kids get older, he could turn that ownership to them and say, here, this will give you a start in life. This will help you not have to struggle as much as I did when I started out. This is money you could be using to help, not just with college. It could be with your first home down payment, which keeps getting more expensive. This could be something to help you with raising a family. This could be something to just really just give you that leg up in life that maybe you never had for yourself. That's the cool thing you could do here. So, guys, I appreciate you, hanging in here and learning about this strategy. Let's see what kind of questions you guys have for me at this point. Okay. Oh my goodness, got a lot of you here. Sunny, hey, welcome. Glad to see you here. So I see your question is there a way to fast track 2.2 million so it won't take 2 years? Fast track 2.2 million. You mean get to 2.2 million? I wonder if that's what you're asking. If so, the question is really, what is that 2.2 million trying to get you, right? And yes, the answer is 5 to 6% annual return that it does make. And it's going up, by the way, because the interest rates are going up. Those rates are actually going up as well. You'll see that happening, especially in 2024 and 2025. Fast track to 2.2 million. If you're just trying to get to 2.2 million because someone told you, like a financial advisor says, you can live on 3%, and so you can live on 66,000 a year, or what is that, 5,500 a month? That's great. Or if you're trying to get to 2.2 million because that means you can live on, say, you invest at 10% and you're making 220,000 a year. Yeah, you could do that. Can you do that? Can you fast track it? Yes. That means don't listen to your financial advisor. Fire them. That's why I'm an anti-financial advisor, right? It doesn't work. The best thing you can do if you want to get to 2.2 million fast, you could use a strategy combined with getting into other alternative investments like different types of real estate, and that could definitely work for you. Okay, so I hopefully I answer your question. If not, you know how to get a hold of us. So let's see. Other questions coming in here. Oh, you're off the example you gave me, or that I've given you. The 2.2 million. What they did, they were putting away over 100,000 a year into their policies, but that wasn't getting them to 2.2 million. That was giving them 2.2 million more than what they were already getting in the first place. So for them, they were putting away over 100,000 a year into those policies, but by lowering the costs of the policy, it allowed their cash, that tax-free savings account, to grow faster. So that's really how we did it. James asked, he says, can you convert any term into whole life, or does it only apply to new policies with the option built in? Any cons? That's a great question. So I mentioned before, like, you may not be ready. Some people may not be ready for whole life insurance. Maybe you should start out with just cheap term. But that being said, I wouldn't just do any term, because many term policies do not allow you to convert to whole life. And even if you could, you may not want to convert to their whole life, because their company's whole life might suck, or they might only give you a universal life policy, which, by the way, universal life, this is not the same strategy you can do with universal life. Some will argue you can do it, but there are so many variables with those universal life policies, and they get more expensive over time. I don't trust them. I used to be a fan of those 20 years ago, not anymore. So when you want to convert, you want a term that converts into a good, solid whole life policy. And there's some great companies out there. We're independently brokered with several, and so we can run those. But I will tell you, you cannot just convert any term. The advantage, if you have term that can convert, here's a great advantage for you. I had a woman, and there's a couple of cases here. I had a woman where she wanted to get a whole life policy, and she said, all right, let's apply. Well, we applied, and something in the last year from the time that we had spoken, something came up in her medical history that made her uninsurable. So they denied her insurance. But then I forgot we actually set up a convertible term insurance policy for her that last year. And I said, you know what? When you get a convertible term policy, your perfect health rating. She had a great health rating too. It was a preferred plus, like the best health rating you can ever get on that policy a year ago. And so I said, you know what? We can actually convert this term policy, and they can't do anything about it. They can't stop you. So we converted her term insurance policy, and you know what? They approved her at that highest health rating. They had to give her that best health rating because she had that convertible option. So that's what we did. We didn't get her a new policy, but we did get her a new policy. But we converted some of that term. We broke a piece off of that term, turned into a whole life policy that had the health rating that she can't even get today. I also had that situation with another guy who's a chiropractor. He was in his mid 60s, perfect health at the time. We got him a whole life policy, but we also got him a convertible term policy. And lo and behold, he ended up getting a brain tumor. Fortunately, he was able to be healed. He did a lot of different holistic strategies and things like that, as well as chemo. And it was able to get to the point where there's no sign of that brain tumor anywhere, even though it was inoperable. But because he had a brain tumor, no insurance company would touch him, except for that term insurance policy that he had that you can actually convert. So even on myself, I don't only have whole life that I'm max funding, and this is the best way to do it. You max fund a policy, although you have a range, you can minimum fund it too. I'll max fund a policy, but then I'll also buy additional term insurance that's convertible down the road that they can't deny me in case anything happens in my health. Key point when I mentioned about max funding the policy. So I mentioned about somebody putting in over 100,000 a year. That's not the required premium. Okay. Depending on your age and your health, most of the time, if you put in 100,000, as I say, the max is 100,000 a year. Usually, you're only required to put in about 20 to 25,000 a year. That's all that's required. The extra 75 to 80,000 is optional. Now, I recommend trying to go higher to that higher point because you get that extra cash building faster, but you're not required to. So, for example, I had a situation in my own life where I set up a policy that was $40,000 a year max. The minimum was about 7,000 a year. Well, situation arose where I didn't have some liquidity at that moment when the premium was due. I didn't have a lot of liquidity. I didn't have 40,000 to put in, but I did have 10,000. So I put in 10,000 bucks. And they're like, great, good, because there's more than the 7,000 that was required. The insurance company doesn't care. As long as they get their minimum payment, that's all they care about. It's like a mortgage, right? They just want the minimum payment. But if you want to pay extra your principal, you can do it. Same thing with life insurance. So I did that. But the cool thing is that 30,000 I didn't pay that year, guess what? The next year, I was able to put in the 40,000 plus 30,000 on top. I was able to catch up on my contributions and do it that way. So really cool flexibility that you get that allows you to do it. So many people, if they say I'm saving, some people might say I'm saving $20,000 a year total between my 401ks and savings accounts or whatever. Great. Let's put the max of that policy at say 15,000 a year or so, where your minimum is only like 3,000 a year. So they're like, oh, that's easy because I could save that in like 2 months. Exactly. It just gives you more flexibility. Let's see. James also, see. Oh yeah, I already got the conversion one. Any other questions before I let you guys go? Anything I have ever missed here? I thought I saw somebody send me a message, but it might have been a Facebook message. So, anyways, guys. So the whole thing is that this strategy can work great for you if it's done right. It's got to be set up the right way. That's why you want to have the max ROI possible. Again, you can go find it. You can find this information anywhere, but I would definitely invite you that if you're looking at this seriously, if you really want your money to start working harder for you, so you have to work so hard for it. If you want to make sure that you have a safer place to store your money than just keep it in the bank, well, unbank yourself. Get that money away. Get that in your better control so that you have control of the terms. You're not in such a risky position. Because the truth is, we know there's something doesn't smell right, right? There's something going on in the world right now. Europe right now is already in a recession. You don't think that's going to hit us too? That's the thing. Us and China, we're the only ones that like to lie about our economies, apparently. So I don't trust that. I like to keep control of my own money because I want to make sure that I have a future, not just for me, but for my family and beyond. And that's what I invite you guys to do. Reach out to us at moneyripples.com if you want to learn more about this. Guys, make it a great day.